All right. Well, thank you for the invitation. And let me start by thanking Bruce and Ken for making all of this possible. This is a great conference. I'm enjoying it. It's very impressive what you guys have been doing for Wharton. I also want to thank Chris and Craig for organizing all this. I know that it's a lot of work. And in fact, I'm going to use the opportunity to also thank the entire management team of the Jacobs Levy Center because everything has gone smoothly. I think they internalized the fact that we're absent-minded professors. They send us reminders after reminder, and everything has run very, very smoothly. And it's impressive to see that at this scale. So thank you very much to all of you for making this possible. All right. Yes, please. All right, so this paper is joint work with Gunther Strobel. Gunther and I were at Wharton when we first met. So Gunther was a PhD student and I was faculty there. This paper was developed later on. But my role today, you're going to see that this is a bit different from what you've been exposed to today in the sense that this is a purely theoretical paper. So the way I view my role today is kind of a link between what was discussed this morning in the various papers. And as you'll see, the jobs that many of you have and the contribution that you make in that job. So I'll talk more about that a little bit later. And the presentation of the award that is about to follow. So all of this is going to be linked through this presentation. So without further ado, let me kind of jump into what I'm going to try to convey here. And the way I'm going to do this is that in fact, my purpose in this paper is really to argue that active money management has probably been kind of underappreciated in the economy. And perhaps the way we value it is not quite correct. So I'm going to propose a number of ways to think about this and show that active money management is actually quite valuable for various reasons. And to do that, and really the best way to convey my point is going to be with this thought experiment that's going to summarize really all the economics of the paper. So there's going to be some technical aspects to the paper, again, related to the work of Sandy Grossman, but the intuition should be in this kind of thought experiment that I'm going to have here. So suppose that we as a group or the entire economy decides that we are going to delegate our money to active money managers. In fact, for the purpose of the discussion, I'm going to call that money manager David. Okay, so David's going to be the money manager. We give him all of our money, and we ask him to make investments on our behalf. Okay, I'm going to ask 3 questions that will essentially summarize the entire paper. Okay, the first question is going to be, what's going to be the gross alpha of the money management industry in that context? Well, it's kind of a no-brainer. If David controls all the money in the economy, he's got the market portfolio effectively. Okay, so essentially the alpha gross is going to be 0. Presumably, David is going to do this by charging us fees. So his alpha net of fees should be negative. Okay, so again, purely intuitive. And the last question is the key, and that's going to be the challenge of this paper. The question is, could investors be better off in that scenario? And this paper is going to argue possibly, and in fact, generally, yes, they are. And the reason is that maybe David is better, or maybe the money management industry is better at allocating capital so that it's as productive as it can be. Okay, so essentially that's kind of going to be the idea. So essentially what we don't see on an everyday basis is a counterfactual of what would happen to the economy without money management. Okay, so that's going to be the idea. So obviously these questions here are not embedded in an equilibrium. It's not an equilibrium statement. Okay, so my job in the rest of the paper is essentially about kind of framing this or structuring this in a way that is going to be more convincing in a kind of an equilibrium model. Okay, so that's my goal. And to give you a sense of how Gunther and I started thinking about this paper, well, he and I and many faculty at Wharton and elsewhere typically start their course by saying, well, finance is about allocating capital to where it's most productive. And in fact, just just for fun, I did this on ChatGPT. I asked that very question, what is finance for? So we start all of our courses with that. What does ChatGPT say? Well, maybe ChatGPT is looking at our slides, but whatever. The answer was exactly what I was expecting. Essentially, it facilitates the efficient allocation of capital in order to create value. So that's what we're going to try to do here. The problem is that when academics in particular think about money management, very rarely do they think about the allocation of capital, an efficient allocation of capital. So typically the models, whether it's a principal agent model or other models, all the models have the following flavor. There's a stream of exogenous returns, and some money managers are good at deciphering what is good and what is bad about these returns. So essentially they can anticipate good and bad returns and make profits or alphas on behalf of their investors. The common assumption, again, is that all these returns are exogenous. So essentially, the production of all firms is fixed, and everything is kind of running exogenously. So in particular, and that's at the bottom of the slide, there's no role in these models for money management to guide production. Okay? So that's what I'm going to try to do here in this paper. And to do this, I'm going to tweak kind of standard models of money management and rational expectations models, and I'm going to tweak them a little bit, and the main tweak is in green right here. So essentially, instead of assuming that skilled money managers are good at deciphering good from bad returns, I'm going to assume that what they're good at is they're good at deciphering the productivity of firms. Okay, so essentially a step beyond what we typically assume. Okay, and that's going to be the main assumption. And the other thing that we're going to need as an ingredient is the fact that what these money managers do in financial markets is going to get reflected in prices, and these prices are going to serve to guide these firms. Okay, so essentially the one assumption that I need in all of this is that, and that's a debatable assumption, but that's the assumption I'm going to make here, is that I'm going to assume that money managers as a group may know something that some firms don't know. So effectively, they can contribute to the value of firms by properly allocating capital. Okay? Everything else is going to be rational in the model, and you're going to see kind of how everybody's making rational decisions. And what we're going to find are two main results. One is that the market portfolio, and in turn, the money manager's performance as typically measured by alpha, is going to be affected by how much money they have under management. Okay? The other result is going to be that regardless of the return performance, what we're going to find is that that industry is going to be quite valuable for the economy regardless of that potentially bad performance. Okay, so that's what I'm going to try to do in this paper. In terms of kind of the literature that I'm building on, and here I'm going to talk a little bit about it because it's important kind of to situate you a little bit. So we know from a long time ago, 80 years ago, Hayek promoted the idea that prices will guide the production. Fama Miller makes similar statements. What I'm going to try to do then is going to bring this to the money management world and see what we can do with that. In fact, the best way to set up my paper is with the last two sentences of the paper by Van Binsbergen and Opp, who are a current Wharton faculty and former Wharton faculty. And they say, well, by simply comparing the performance of active and passive investors, the gains from altering real economic outcomes are not taken into account. Okay, so this is kind of what I'm going to try to take into account. This raises the possibility that active management should not be discouraged. And so that's kind of what I'm going to make, that's going to be the point I'm going to make. Once you do take that into account, you find that activity is a lot more valuable. Okay, in terms of the more specific modeling ingredients that I'm going to use here, I'm going to take three strands of the literature in finance. One which deals with rational expectations model, and we're going to talk about these models quite a bit in the next presentation, which takes the idea that prices reflect the information of traders. I'm going to try to think about these feedback effect models, where essentially prices inform inform CEOs and CFOs, inform firms about what they need to do. And finally, I'm going to embed a rational model of money management into that. So I'm going to kind of take these three things together. And to be a bit more specific, here are the papers that I'm going to draw from a little more than the others. One thing I want to kind of mention is that two of the papers, the two papers highlighted in red, are the papers that Sandy wrote a while ago that we're going to talk quite a bit about in a few minutes. And literally, perhaps with the exception of the Kihlstrom-Merman paper, this entire list of papers is not writable without that initial paper. So essentially, this created a huge set of possibilities for financial economists to think about the role of prices in reflecting information. So I'm going to build onto that a lot. Another paper that is quite useful to this specific paper is the Dow-Rae paper, which I'm going to closely align with. But for now, essentially, I'm just blending these three things. All right, so in terms of the issues and questions that I'm going to try to address, I'm not going to dwell too much on each of the papers that make these arguments, but obviously there's been a long time debate about the performance of value of money managers, and that debate always centers around returns. What I'm going to try to do here is try to think more about what is the welfare in the economy that this activity adds. Okay, so I'm going to try to think about it that way. In terms of the fees of active money management, they're often perceived as deadweight costs. Well, in this model, they're going to be more like investments. So essentially in the sense that this is the price that we have to pay to get better money allocations across different firms. Okay, so that's going to be kind of a more positive version of these fees. And then finally, there's been a lot to be said about kind of, well, the arithmetic of money management should be that the alphas are zero because, well, for every buyer there's a seller, for any gain there's a loss, and so on and so forth. Some people like Peterson have kind of tried to think about the composition of the market portfolio. What we're going to do here is even more extreme than that. We're going to say that the market portfolio's returns are not fixed. So essentially they depend on how much money management there actually is in the economy, okay? And we're going to try to think about this quantity alpha, whether it measures everything that we want it to measure, okay? So without further ado, let me jump into the model. And what I'm going to try to do is again, it's a theory paper, but I'm going to try to keep the story kind of relatable, even though it is theory. Okay, so what I have here is an economy. It's a one-period economy where essentially I'm going to have a lot of investors. So that's what the mass one means. I'm going to have one fund manager. We can extend that to multiple fund managers. So I'm going to have one fund manager. His name is going to be David. I'm going to have one market maker and firms. So in terms of timeline, what's going to happen in this economy? Well, David's going to announce the fees that he's charging for investors to join his fund, okay? And investors will decide whether they want to go with David or not. Then the shares of each stock are going to get traded in the financial market, and firms will observe what's happening there and choose make real investment decision based on that activity and what they learn from it, okay? And finally, I'm going to have payoff and consumption. All right, so that's the economy. Let me give you a sense of what these end firms are. And this is really, the key is really that first line, okay, the VN. So that's going to be the payoff of every firm. What does it depend on? Okay, well, there are two terms, theta and epsilon, that I highlighted. So essentially, the sum of these two is kind of measuring the productivity of each firm. Okay, and so if the firm is going to be very productive, and these quantities are not known ex ante. If the firm is going to be very productive, we'd like to have a large K. That's a large investment, okay? So to the extent that a firm knows how large these quantities are, it's going to change how much it invests, okay? And this is going to be the informational advantage of money managers in this economy. They're going to learn about theta. Epsilon is going to remain unknown by all market participants, okay? So that's kind of the idea. There's a bunch of square root of n and n. Don't get distracted by that. It's really just about making the economy converge nicely if I increase the number n of firms in some of my results. But essentially, what we have is this production, and firms will learn partially about theta through prices, and that will allow them to make better investment decisions, okay? So think about a firm that announces a merger, stock price drops, while something is telling them that maybe that's not a good investment, okay? So that's kind of the idea here, all right? In terms of the investors themselves, like I said, I'm gonna have a large number of them. They're gonna have what we call carry utility, carry preferences, essentially exponential utility, and they're going to be born, all of them, with the market portfolio. So if they do nothing, these investors have the market portfolio. So essentially, they're born as indexers, okay? They're going to have to make two decisions. One is whether or not to go with David to invest their funds, and the other one is to choose their demand, okay? Of course, if they go with David, David will do that on their behalf. But if they choose not to go with David, they're going to have to submit their own demand for each stock in the economy, the N stocks. Okay. Now here's where kind of I depart a little bit from the work that Sandy did in the 70s and 80s. I need to be able to measure welfare. That's kind of the goal of the paper. So in all of these rational expectations models, we need some kind of form of noise to make sure that that stock prices do not fully reflect the information that some investors have. So essentially, the noise serves as camouflage for the investors, so for the informed investors. So without going into the details of how I'm doing this, what I'm going to try to think about is another role that financial markets have, which is risk sharing. So essentially, I'm going to assume that some investors have a position that they'd like to hedge, that there's some risk that they'd like to get rid of, and financial markets will allow them to do that. So that's going to be the second role of financial markets. And the ETAs, ETA 1 to ETA big N, are going to be kind of the extent to which they need to do that, and these are going to be drawn randomly. Okay? So again, this is just a way to introduce noise in the model so that I can still measure welfare. Finally, I need to think about the active fund manager. What does he or she do here? Well, they're going to learn again about theta, and they're going to learn about these shocks of the fund investors, and they're going to trade on their behalf. And then obviously, what they're going to try to do, so David is very nice, but in the model is not going to be that nice. He's going to try to maximize profit. So that's kind of the idea here, okay? And finally, what do financial markets do? So I'm not going to go into the details here, but effectively, everybody's going to submit their demand, and all of this is going to get aggregated. And the market maker, who I'm going to assume is risk neutral, and that's one of the deficiencies of the model. I can talk about it a little bit more in the discussion after the talk, but we'll set the price equivalent to the expected payoff given all the information that the trading process reveals. And then finally, and this is yet another loop in the paper, is that this equilibrium in financial markets will serve to inform firms of what they need to do going forward. So essentially, prices tell them how productive they're expected to be by financial markets. All right, so typically in a talk like this, I wouldn't go into the equilibrium derivation. I think I've shortened it quite a bit, but I still think it's useful to go through some of the manipulations, again, without going into the details. One, because they're quite instructive about kind of how this economy works, and two, they relate very, very closely to the work that we're about to discuss for the Jacobs Levy Prize. So how does that work? Well, there are really three quantities that I need to pin down in this economy. One is how much David's going to charge for his services. Two, how many investors will choose to go with him, so that's lambda. And then finally, I need to think about what the financial market equilibrium is going to be ultimately. So what is the equilibrium in that, okay? And it boils down effectively to one parameter, is essentially a parameter I'm going to call phi that measures how much noise is in the price, okay? The way I'm going to do this, and here I'm going to do this fairly quickly for the rest of this slide, the way I'm going to do this is by backward induction. So we're going to say, well, if I know F and lambda, what's going to happen in the financial market? Knowing what's going to happen in financial markets, investors will say, all right, given what David is charging them, that's step 2, given what David is charging them, do I go equipped with the information that he's going to use to trade on my behalf, or do I go completely unequipped and face these financial markets on my own? That's essentially the question they're going to ask themselves. And then finally, knowing all of this, or anticipating all of this, David's going to say, well, here's how much I should charge for my services. Okay, so that's kind of the idea. All right, so briefly, so how does that work? And this is really the beauty of the work that Sandy did 50 years ago, thinking about these issues. So essentially, the idea is that prices are informative, but not perfectly so if there's some noise. And that's the way we're going to capture this. And it turns out that prices in this model, or at least we can conjecture, that they're going to reveal a combination, in fact, a linear combination of fundamental and noise. Okay? And of course, if the noise is very little, the prices are going to be very informative. If phi is very large, then the prices are going to be mainly noise, and investors are not going to learn anything. That's kind of the idea here. Okay? And that all comes back from, Sandy's work originally. All right, so once we have this conjecture, I'm not going to derive these things, but think about this. Now we have a conjecture, so we know kind of how firms are going to choose their investments. We know how market makers are going to price this. We know the demand of each type of investors, whether they need to hedge or not. And so we can solve for all this, and ultimately what we can find, without going into the details, we can find a phi that makes it all work, okay? What does that mean effectively? Well, it pins down the phi that makes the conjecture that we started with correct, okay? So it's a fixed point argument that we use ultimately. So if you look at delta, for example, you can see that the real investment of the firm is going to be affected a lot by the information in prices, by tau, when delta is large. When is delta large? Well, you can see with the expression on the right, delta is going to be large when phi is small. And when phi is small, you can see at the very top, that means that there's very little weight on the noise, and prices reveal mostly information. Okay, so that's kind of what's going on in the model. What we find is that the phi that makes this work has that form in the bottom right corner. Okay, and you can see that phi is going to be small when lambda is large. So lambda, remember, is the number of people investing with David. So essentially, it's the size of the money management industry. Okay, so when the money management industry is very large, phi is small. That means there's very little noise in prices, because essentially everybody's trading on that information that David has gathered. He's got a lot of capital to invest, and that reveals a lot of information about what he knows. Okay, so that's the idea. Now, the fact that phi and lambda are negatively related is going to be useful too. And again, that's an insight from Sandy's work. What we find in these types of model is that the benefit of going with David versus the benefit of not doing so is decreasing in lambda. What's the intuition here? Well, if more and more investors are going with David, prices are going to be more informative, which means I don't need to go with David because I'm going to get a lot of information from prices themselves. That's kind of the idea, okay? So there's going to be a number lambda that's going to make this work. The form of it is irrelevant. It doesn't matter too much, but a challenge is to keep tractability throughout. And what it says, let's focus on the first equation. David sets F on the left-hand side of this equation. If he sets a large F, we need phi to be large. How does phi get to be large? Well, it gets to be large if lambda is small. So what does that mean? When David sets very large fees, very few investors want to invest with him. Okay, so essentially when he's expensive, people say, well, you're too expensive. I'm going to go elsewhere. I'm going to do this on my own. Okay, so that's the idea. All right, so that's the first property. There's also some more to be gathered from this relationship. So for example, when the informational advantage that David has is large, he's going to get a larger lambda. So essentially, When his informational advantage is large, then investors will come in. The last point is related to the noise. So when there's a lot of noise coming from hedging, David has more camouflage in financial markets, and so can kind of use his information more productively or more profitably. Okay, so that's what we see at the bottom. The last thing that I want to talk about for the last step before we go into the results is that notice that lambda, the number of people who invest with David, is decreasing in the fees. Okay, so again, David is not doing this activity to be nice. He's going to try to maximize his profits or his revenues. So essentially, he knows that if he charges a very, very large F, he's going to get 0 investors. And likewise, if he charges 0 for his services, then his revenues will be 0. So there's going to be a number between 0 and infinity that's going to make his profits maximize. Okay, and that's kind of the goal here. Okay, I'm going to go directly to the result because we can solve for the fees now. And what it says is quite intuitive at the bottom. It says that when David's informational advantage is large, he can charge larger fees. And likewise, when there's more noise trading or when there's more hedging or better camouflage, he's also able to charge more for his services. So at this point, what we have done is pin down the entire equilibrium for the economy, again, largely building on the work of Sandy and others after him. And what remains to be done is essentially go back to some of the quantities in the economy. And if we agree with the assumptions, again, some of them can be debatable, some more so than others, but at this point, the results are kind of unavoidable. So now I have the equilibrium, so I can look at how people trade in this economy, what are the expected returns, what is the welfare, and so on and so forth. So essentially now it's just about measuring things, okay? So that's what I'm going to proceed to do next. I'm going to try to measure things, okay? The first thing is the performance of investors and the funds, okay? So in particular, one of the exercises that Gunther and I wanted to do with this paper was to compare an economy with and without active money management. So essentially, what is the contribution of active money management to the economy in a model like this? Okay, well, without money management in this model, the model is really, really easy to solve. All firms are identical. Nothing is learned about any of the firms. Every firm invests the same way, and they're all identical. So it's kind of a boring version of the model, but what that allows us to do is to measure the contribution of money management to that value of the economy. And in particular, if I sum up the market portfolio or the entire value of all the firms, what I find is that it's going to be the value without money management plus something. So essentially, the pie does get bigger with money management, and more so when, for example, when sigma theta is large. So that means when there's a large dispersion in how productive every firm is. So there's a lot to learn about their productivity, and C is kind of the adjustment cost, is how much they can adjust based on that information. I'm also going to measure returns. So here I'm going to forego all the equations, but kind of picture the following, that what I'm measuring here is that I'm defining what returns everybody's going to get in this economy, okay? In particular, I'm very, very preoccupied by a couple of quantities. The first quantity is at the top. What is the return of the fund? Well, the return of the fund is going to be measured in this economy. I'm very concerned about the market portfolio. The market portfolio is going to be, well, what is the performance of all the investors in the economy? And of course, I can calculate alpha by comparing these two quantities. And I can measure the gross alpha, and I can measure the net alpha, which is just subtracting fees, okay? And now I'm going to try to measure how big these quantities are and what makes them bigger and smaller. Okay, so that's the goal. So what we find, the first thing that we find, this is not a surprising result. What we find is that investors who do go with David perform better. They have better returns. It's not super surprising. David has got some information. He's taking their money and he's using that information to invest that money. So the fact that they have higher returns kind of makes sense. It makes sense and it's intuitive, but it leads to another question, which is, why doesn't everybody go with David? He's got higher returns, okay? And this is where the welfare aspect of this model comes in. So it turns out that when we go with David, the positions that he's going to take are going to be more extreme, right? So firms that are very productive, he's going to invest a lot in, for example. Well, that creates a lot of risk. Investors are risk averse, so they're going to bear the cost of that. So essentially what they're facing is that they're getting higher returns, but also facing more risk. So that's going to be the trade-off that they're looking at. And again, in the equilibrium to the model, they're going to be indifferent. So they're going to say, well, do I prefer higher returns and higher risk, or do I prefer low return and low risk? Okay, so that's going to be the first thing. Second thing is that, what is the alpha? And this is really kind of the one that we were surprised about when we first worked on this. So it turns out that the expected return of the fund manager is going to be the market plus another term. Of course, that other term has to be the alpha. It's essentially everything else that they create on top of the market. And what we find is that that quantity, well, first of all, is greater than 0, so that's good news. Information leads to gross positive alpha. That's fine. But interestingly, what the interesting aspect is that it is decreasing in lambda. So what is this saying? It's saying that as more and more investors go with David, go with the fund, it becomes harder and harder to generate higher alpha. Okay? So essentially, the benchmark is more productive. Beating that benchmark becomes a lot harder. That's essentially what's going on here. Okay? It gets even worse when I look at net alphas. So if I subtract the fees, it's still the case that the net alphas are decreasing in lambda, but then it gets even worse because if lambda is really large, so essentially if a lot of investors choose to go with the money management, to go with the fund, it may turn into a negative alpha. So essentially, when lambda is very large, we may have a negative alpha. And of course, it leads to the next question, and I have this at the bottom, so I'm going to skip the equilibrium lambda and F. I have this at the bottom, is that why do investors who have a negative alpha choose to go with David in this model? Well, there are two alternatives. One would be that they could stay completely inactive. Remember, they're born with the market portfolio, so they could keep indexing and just kind of sit on their portfolio. It turns out that that portfolio does give them a 0 alpha. The problem is that it also comes with a lot of risk in the sense that firms will adjust their production, and so some firms will have a lot of weight in that portfolio, some firms will have a little bit of weight, and for an investor who's completely passive, it turns out that that risk is quite costly. In fact, their expected utility would be improved by going with David. And likewise, these investors who are active but not with David, remember that they're indifferent in equilibrium, so they are equally well off. So they're not hurt by this. Okay, I know I'm out of time. The last thing I wanted to do is kind of mention something at least about investor welfare in this economy, which we can measure. Okay, long story short. Okay, so what do we find? I have two main results. I'm just going to describe them with words. It turns out that all investors in this economy benefit from David's presence, whether they go with him or without him. Why? The pie is bigger. Okay, so essentially, yes, David's keeping a share of the pie because he's collecting fees, but the pie is bigger to begin with, and all investors participate in that. So it turns out that all investors benefit from that. The hedgers have a little bit more of a trade-off in this economy. Why? They also benefit from the larger pie. That's good. But the problem is that hedging becomes a little bit more costly. So now when you sell shares because you have some external reason to sell them, it may be misperceived as informed selling, and so prices will adjust against you. Okay, so essentially hedging becomes more costly, so there's a bit more of a trade-off. But all of this to say that in a lot of cases, there's a very large set of parameters where essentially everybody is better off, and this is even though money managers potentially have a negative alpha. So I'm going to skip the extensions here and just kind of leave you with kind of the punchline. So essentially what we have, the main thing that we bring to the picture is this idea that money managers have information that is not about exogenous returns, but about production. And this just little tweak turns out to have profound effects on the type of equilibrium that Sandy and others have described over the years. And in particular, it tells us that active money management can be very, very valuable, and that alpha may not be the best measure. All right, that's it. Thank you very much. I look forward to hearing from David.
Thanks, Simone. And so we'll now have David Musto present the discussion.
All right, great. Well, thanks. And I'll actually just add one thing, as Dean James mentioned this morning. Well, that was a nice introduction that Craig offered, but it's been overtaken by events. I am now the faculty director of the Dr. Bruce I. Jacobs Master of Science in Quantitative Finance. That's the next chapter in my life. Hopefully not the last, but if that's what I get, that's what I get. But looking forward to that, and I had a great time talking to you all about it, and keep in touch. Those of you who've told me about how, you might be looking for interns and ways to get involved, keep it coming. Absolutely. Okay, let's keep talking. Email me. That's what I do now. So this is a fun paper to read, and also fun discussed paper by Simone, my colleague from my early years here, and Gunter Strobel, is a doctoral student, Wharton product, and we're going to a conference in Vegas with Gunter, and they had this enormous Texas Hold'em competition, and he won. So I sort of bore that in mind reading this, that this is a guy you don't want to play poker against. And it reminded me one thing, of course, one of our companies, one of our advisory board members for the Jacobs MSQF is from Susquehanna, and those of you who are at Susquehanna have been there know what's their trading floor? Their training floor for their all poker tables, right? All poker tables, right? So Gunter's halfway there. Okay, great. So when I heard I was going to discuss this paper here, and here, look on the right side of this picture here. That's where we are right now. That's the Marriott Marquis, right? And what's that? That's fine. This is the Wharton School. No trigger warnings at the Wharton School. That's the pandemic right there. As you can see, 5 years ago, it was dark times, and dark times for the Marriott Marquis and the whole Marriott chain. I'm bringing this up. Why do I bring this up? Because I have, in my one of the classes I teach, capital markets, I talk about, the whole bond issuance process and thinking about, what bonds you're going to issue and how you negotiate them and so on. And one of the deals that I started talking about during the pandemic, and I guess it's still there in my class notes, is Marriott going to the markets in the early days of those dark times, April 14th. All right, remember it was like, this is going to be a tough 2 weeks. Remember that? Just stay inside 2 weeks. And anyhow, this is by April 14th. I thought about this just because, you could see they're going to the market, and this is how, as you guys in the fixed income world know, this is kind of how it goes. They announce before the open, well, we're kind of looking for this size, this spread, and they're scraping the very bottom of investment grade, as you can see. And then they're talking to investors over the day, and then 3 o'clock they say, well, it's big. We've expanded it to from 1 to 1.6, and the coupon all the way down from 7 1/4 down to 5 3/4. Right? So they're learning, right? They're learning from the market, and of course they are raising money for, in this case, obviously just to weather the storm of the pandemic, but they've heard good things. And you can imagine this situation where kind of crowdsourcing the question of, what do we make of this? None of us has been through this before. What do we think of this? What kind of optimism should we have? And they hear a lot positive things from the market, and the whole thing flies out the window at a much better coupon. And so, okay, so I was thinking that's sort of learning from the market, and it's sort of feeding right in to your production decision. And this is the stock market reacting to all that as it happened. So what's going on in this model? Actually, let me actually see if I can sort of map this out without falling off the stage here. But think about the various players. Basically, there's one, let me just sort of say what Simone said, but without the equations and with a slightly different spin on the same exact thing, right? So what's going on in this model? You've got someone, I'm going to call him an analyst. You can call him a fund manager, but all that's really important is this is someone who's figured out what companies should do, right? Knows that. Other people don't know it, but the analyst does know it, right? And what's he going to do? He's going to sell this information to investors. And these investors, a continuum of these investors, so they're all measure zero, and their trades don't matter. Their trades are infinitesimal. They can trade, and they do not even think about price impact when they trade, all right? And then when they trade, well, where's the kind of noise coming from that would allow them, in sort of the Grossman-Stiglitz sense, to profit from their trades? Well, that's coming from hedgers, right? So the whole chronology here is first the analyst pitches this opportunity to buy information to everybody, and then it pitches a particular price, and a fraction of people say, yeah, okay, I'll do that. And then of those people say, yeah, yes, well, some of them turn out to be hedgers, and if you're a hedger, then you say, well, no, actually, I'm not going to buy your information because all my trading is just going to be the hedging, right? But for the people who aren't hedgers, let's say, yeah, I will buy that information. They buy it and they trade, and when they make this trade, they are their trade decision is very simple. As I say, they're measure zero, so they don't even think about their impact on the market. They're price takers. But what is that price they're taking? Because everything kind of hinges on that, right? So they make this trade. They collectively make this trade. They're all sort of, making the same trade. And then you have the noise trade from the hedgers. Those two things come together. The market maker sees that, and of course, because there's the noise, the market maker, updates the price, but not the noise keeps the market maker from completely inferring what's going on with this information. So updates the price, and then not only is the market maker sort of learning and updating the price, but then the companies themselves are watching all this play out. They know that information is out there. They don't know what it is, but they know it's there. They know about the noise. So they're inferring. They learn something about what to do. They learn some of the information about what they should do. And so they do that. And by doing that, they change the value of the firm. And then that, of course, feeds all the way back. People know that's going to happen. And so that feeds back into the expected return that is, the numerator of the expression that, of the demand function that these investors have when they trade, right? So think about the feedbacks going. I mean, it took me forever to go through this whole paper and figure out, see all the feedbacks. I would pick up the paper and say, oh my gosh, I got to go have a beer. And then I come back, it's like, now I really can't understand it, So, but I did finally, sort of figure out all the feedback loops here. It's I would say, I look at this and say, well, this is it. They've answered the question here. You need all these feedbacks in this model to address this question of selling information that is information about what companies should do. You need to incorporate, all the feedback all the way back from what companies are actually going to do into the price, all the way back to the expected return, which drives the trade, which then feeds back in the other direction into the updating. So the whole thing is a tour de force of modeling, and I view it as sort of, in my mind, definitively answering the question about that particular way of an analyst monetizing information about what companies should do. All right. There's a lot of things, as Simone was saying, there's a lot of things that this paper isn't. If they tried to address any more, then I never would have finished it. So it's not really about, the question of indexing versus active trading really doesn't come up here, because you've got this, you've got this risk neutral market maker with with infinite wealth in the middle of the model. And so you're sitting there as a risk-averse person holding the market. It's like, well, here, take it, right? Of course, you're going to sell the whole thing. The only trading you get in the model is the trading driven by these information coming from the analyst and the hedging, and just people just dumping their whole portfolio. It's not about the wisdom of crowds either. This isn't about, something kind of like the pandemic where everyone kind of has an opinion about what's going to happen next year, and you're kind of putting that together into a price. This is really specifically about, there's a guy, he's got this information, and he's trying to, get the most out of it, make the most money out of the fact that he has this information about what companies ought to do. There's also no principal agent problem in this either, right? In this model, the manager of the company, when he sees when he learns what to do, he does it. And with the person selling the information, there's no question but that this information is right. And if he sells it to you, he tells you he's honest and so on, right? So that's what's going on here. It's like all the different feedbacks it takes to think about selling information to traders on what companies should do. So it had me thinking, since I feel like that question is answered. There's not much to say about it. I mean, it's you see the equilibrium, and as Simone was walking through, you can see how the economy benefits from active management, even if you don't perceive it in alphas. But it did have me wondering, if I were to, where else could you go with this model? I was thinking, well, okay, this is one thing you could do with your information about what a company should do. You sell to people, and then the information is going to be revealed to the price, but that's pretty blunt instrument, right? The price is just, the price of a stock could mean a lot of things. And the company has many dimensions of what it might do next. So in the model, there's just one thing, you scale it up or down. But in the real world, of course, there's lots of different things a company could do. The stock goes up, stock goes down. Maybe you know what this is about, maybe you don't, right? So what else could you do? Well, naturally, the other things you could do are, number one, activism. So you take your information and you buy a stake and you make your case, right? You buy a stake, you sneakily buy up a stake of the company, and then you file your 13D and you own whatever percent, and you say, okay, here I am, here's what I think you ought to do. And either they agree with you, in a model they would agree with you, but in the real world, of course, oftentimes it's like, well, they know your idea, they have their idea, they want to do their thing, you want them to do your thing, and then you have an argument. But of course, if the stock market goes way up, when you announce, here I am, and here's what I want to do, then you've kind of put them on their back heels. It's like, well, okay, I don't think it's a good idea, but obviously the market does, and if I don't do it, the market's going to go right back down. So there's that. And then, of course, there's private equity, right? Just take the company private. You have a good idea for the company, just buy it, do it, sell it. Now, of course, there's been quite a lot of both activism and private equity in recent years, maybe possibly even too much, but that is, those are the alternatives. So when I'm thinking about this model, about, say, well, okay, here's what happens, here's how it plays out if you have this information, and the way you're going to monetize it is sell to people who are going to then trade on it. Well, yeah, that's one thing you could do, but there's other things you could do instead. It's, so that's sort of, I would like to step back from this, widen the strategy space for the person who owns the information, and then just ask what would be the best move here. And also, as I say in my little anecdote there, I'd be just curious, in this, I realize there's a piece of theory here and let people tell their own stories based on the theory, but I am curious, like, when do we think intuitively this is how outside research affects production, right? So the research is not directly revealed, it just sort of comes to you through prices. I view the debt markets as maybe a little more a better setting for this kind of thing, because you go back and back and back to the debt markets. You don't generally go back to the equity markets. And when you go to the debt markets, it's relatively clear what you're going to do with the money and so on. And you have a lot of, bells and whistles and elements of the debt contract to negotiate. So a lot of opportunity for information to be directly or indirectly revealed. And as we saw, you go to the market with, one size and coupon in mind, and you come out with something else. This is all, to me, it seems like a more likely venue for a situation where people's private research ends up affecting production. So I know that in the model, there's sort of like no debt or equity. It's just one claim on the whole firm. But in reality, debt markets seem to be maybe a somewhat better fit to this concept. So put this all together. This is a really impressive extension of Grossman-Stiglitz. Taking the Grossman-Stiglitz dynamic and embedding in a situation where the information is not just about securities value, but in fact about how to run the company, which then affects the securities value. And working through all this is amazingly complicated, just in the simplest setting, which is appropriate. As I say, there's lots of ways to affect production by public companies. And I would like to think, so that's the main thing. If Gunter are going to follow up on this, and I hope they do. I mean, this paper is good to go the way it is, but if they want to follow up on this, it's embed this in a bigger model of, I've got information, how am I going to use it, and what does that mean for the economy? So that's it, thanks.
Simone, we have time for a few questions. Any questions or comments?
We're going to thank David for
I'll let
a great discussion. Now remember why it was so much fun to write papers with him. So he takes my nerdy equations and kind of translates them into something that's a lot more relatable. So he hasn't lost that skill, and it's wonderful to see that live. For the most part, I will take the questions, but for the most part, I agree. In fact, for the entire part, I agree with David's suggestions about where we could take this. And indeed, some of the ideas that he's mentioned, we're already exploring. In fact, that paper started as a VC paper, which was really about, I'm going to invest, and now I'm going to take an interest in your company in terms of trying to think about what you should do. So essentially, at that point, there was capital, but there was also voice in that model. So we haven't done that because it turns out that capital was already a big step to take, but we're thinking about these issues. All right, so that, again, thank you, David. That was wonderful.
Rob?
Yeah, it's a very interesting paper. I think one of the most surprising implications, I guess, from the investment perspective is that you'll have investors willing to earn negative alpha rather than just seemingly just free ride by buying the index fund and let others make the economy better. I think where this comes from is that you've got this non-tradable endowment of wealth, right? So if I've got this non-tradable wealth, the negative alpha asset helps me diversify and get to essentially a higher Sharpe ratio, higher utility, right? If I were an investor without such an endowment, suppose I were an investor, well, I don't know. I don't know who this would be, but maybe like a retiree with no human capital that's going to be economically sensitive or something like that. Then I think I would just free ride, just buy the index fund, right?
I think you're right. I think ultimately, here's kind of the deficiency of this model is that we're kind of measuring things in terms of alpha, but alpha is not really the proper risk adjustment in this model effectively. So that's kind of because there, as you say, there's these other assets that we can't trade in, and so really the way to do this really correctly would be to think about all these other motives and kind of adjust the alpha properly. We haven't quite gotten there yet, but I think you're right on the money that essentially there's a reason why the negative alpha results happen. It's a little bit of like cheating. It's no longer the right measure in this model. Okay. So I agree with your point. We just haven't come up with the right way to kind of think about this.
So I just had a question more about the details. So related to David's discussion, is this a scenario where you're simply selling the information that'll be used by people that don't internalize price impact, or is this the decision of a manager who is internalizing that he's organizing the trades of a lambda fraction of the population and therefore essentially will act as a monopolist there, will not act like a measure zero agent?
So the manager is, well, in the model, he's monopolistic. So obviously he knows the effect he's going to have. But what he views, how the market is going to work is that he internalizes the fact that traders are going to trade without price impact. So that's what he takes as given. But the question is, how much information should be out there? And that's what he controls with F, with the feed. So essentially, think of it in game theory terms, think of it as F determines which game we're going to play. So as soon as I pick F, I know how many lambda I'm going to have, how many investors I'm going to have, and what trading game they're going to play. That's essentially the way the model works. And he's going to internalize all of this to maximize his revenues. So that's the idea. We do have an extension because a lot of people ask us about what happens with competition. Okay, and I had a slide on this, I didn't present it, but what happens with competition, there's an interesting other aspect that comes in is that when David picks his fee, he takes every other fund manager as given. So essentially it's a Nash equilibrium in that. In particular, he doesn't internalize the negative externality that he imposes on you because prices are going to be more revealing. Okay, so essentially it incentivizes every fund manager to actually have more investors than they, well, that is globally optimal. And so it actually pushes more investors to invest with funds. And ultimately, it is more likely in the model to end up with negative alpha as well. So essentially competition in this model actually leads to more negative alphas. And the main reason, which is kind of what we hadn't internalized at the beginning, is the externality that David imposes on you when he gets more investors.
Thank you for the amazing presentation. I just wanted to ask, how can you ignore price impact? If more and more people invest with one fund manager, won't his information be less valuable because he'll move the market?
You know, as a group, they're going to have a price impact. It's just that each individual investor is so tiny that they don't have any price impact. They're like
But if they invest with him,
well, as a group, of course, they're going to have, that's what makes the model work. Essentially, they're going to affect prices because as a group, they're going to move prices in one direction.
so the fund manager is not one entity. It's
Well, the fund I would put it
Go ahead. Yeah, might as well.
is that, you know, clearly I'm the fund manager here, and I pick the fee F, and then that determines lambda, and that determines how many people trade, and these people are going to trade purely without any price impact in mind, but I know I can integrate, I can add up how big that's going to be, and I'm scaling that ultimately by choosing F. I'm scaling that to the amount of noise trading that I know is going on.
okay.
Yeah.
Well, thank you.
We need to write a paper together.
And I should add, but also in the model, just bear in mind that in that car utility demand function, everyone in the economy except the firm manager completely figures out the information, right? Because all the investors know what the information is, and then all the noise traders, because they know their noise, they can figure out what the information is also. And so in fact, the risk in the denominator of their car utility is just the residual variance nobody knows about, sort of the noise that's going to hit the economy, you know, after, yeah, correct.
Okay, well, thank you very much, Simone and David.
David.